All right, hello everybody. For purposes of the streaming, that there's some folks at home and what have you, but a couple of the clients are in the office here team. So welcome everybody. This week's Market Huddle, the Lunch and Learn. Once a month we invite families out here. We share some lunch and do more of a live stream presentation. This week, Toys for Tacos. We brought in some buffet. How's the buffet? All right, some taco buffet here, and asked everybody to join us and bring in a gift. Now, if you'd like to swing by the office and bring a gift for Toys for Tacos, or make a monetary donation to the Marine Corps Toys for Tots. The last day, I think we're right now scheduled to be picking up our boxes on December 16th. So we have up until Thursday, December 16th. So if you'd like to do that, then all of that would be greatly appreciated. So this month's discussion is going to be really around charitable gifting. The vast majority of charitable gifts throughout the year are usually in the month of November and December, from the time of Thanksgiving till the end of the year. And any charitable gifting has to be accomplished for 2021, has to be done before December 31st. So we'll talk a little bit about changes in gifting that have occurred in the last few years, and maybe some things that you are or not familiar with, and some things and ideas if you do charitable gifting as part of your retirement planning. So with that said, here's the disclaimer. As most of you already know, I don't work for the federal government. In fact, we spend a lot of time trying to make sure that we can eliminate some of our footprint with the federal government, and I don't work for the Social Security Administration. I'm not an attorney. I'm not a CPA. So anything I say that sounds like tax advice, encourage you to check with a tax professional and such. So with that said, keep in mind that as we are going throughout our lives, at the end of the day, ultimately our money will end up in one of three places. Typically we have our family, charitable gifting, charities, and we have the IRS. Now, if I asked the room where they would rather have their money go first, most families we work with here at Secure Retirement, it tends to be that they would prefer whom? Their family. However, if we resort to the default, as many of us do, where does our money end up going someday? The IRS. So with a plan, with some strategies, we can make sure that your goals and intentions are best met, and I encourage you to visit with one of our team members on how to do that. So this right here today, though, we're going to be focusing more on active gifting to charity, not necessarily at the end of the day estate planning and what have you, and some of the things to look at there. Big change in the IRS tax code here in 2018. One of those changes is that they increased the standard deduction that we all give as taxpayers. Now, if you are a individual tax filer, you file a separate single tax return, the amount that can be standard deduction amount here in 2021 is $12,500. If you are a married couple, it is $25,100. Those numbers are going to be increasing next year. I did write them down, to $12,950 or $25,900. Now, what that really means is this. Most of us wouldn't argue that the tax code today is at 25-year or maybe even 40-year lows. We have not seen tax rates at these levels for a long, long time. But because of the standard deduction and the amount that everybody gets to give, oftentimes families are not necessarily getting a tax advantage for the charitable gifting. I want to stop right there. The idea behind the gifting should never be probably because of the tax benefit we get. However, with today's tax code, there are some ways, grab a seat anywhere, Paul, that we can utilize the charitable gifting and still get tax credits. If we can do that, that's kind of a win for us. It's a win for the charity. And I guess the only one that might lose out there a little bit is the one that we've already said back here, our least favorite charitable endeavor of the IRS. So with that said, let's talk about 3 different takeaways or things that we can all be doing or considering in our retirement planning. Not everybody can do all of these, but these are all 3 areas that when we're sitting down with families looking for ways that we can make some savvy tax smart gifting decisions, things we can look at. So, gifting your gains, grouping your gifts, or gifting for the, from the IRA. These are the 3 themes here that we'll go through, and then we'll wrap up today's discussion. So with that said, gifting your gains. All too often, most families do what? When they're doing a charitable gift, they pull out the checkbook, they write the check, they keep that check, maybe they put it on a credit card. I know a lot of families are doing monthly donations to their religious organizations, or maybe it's some of the veterans benefits or what are veterans 501c3s and what have you. Writing a check is a good option, but if you do have something that's appreciated in value, oftentimes that's a stock. It could also be real estate, it could be anything that's actually grown in value. If I were to sell a stock, I would have to pay the capital gains and then I would write the check. If I gift a stock, let's say I had a stock that we paid $1,000 that's worth $2,000. I give $2,000 a stock to a charity of my choice. The charity can sell that stock without any tax consequence, and we get full credit for the full $2,000. So what we've really done there is we've avoided paying any kind of capital gains. Given the choice, especially with charities that might be a larger amount, more than a couple $50 or something, if you have appreciated assets, you should consider how to gift that before writing checks. Does that make sense? We can sit down with you if you want to go through this. If you have a portfolio with some investments that are appreciated, let's sit down and look at some options on how you might be able to better utilize that. I'm going to talk about another concept which sometimes we can use this appreciated stock, and that's grouping gifts. Primarily when I talk to the donor advised from the DAR, we'll talk about how that would work. But really the concept of gifting and utilizing groups is a lot of the result of what's happened here with this higher deduction. If you remember, a standard deduction this year is $25,100. Next year, that deduction for a standard deduction under age 65 is going to be $25,900. If I give a charitable gift and I do not exceed that $26,000 standard deduction, I don't get the benefit of that on my return, right? So here's how it would work. There's 2 ways we can group gifts. One is calendar, one is the donor advised fund. We're going to focus on the calendar. It's the easiest and cheapest option for somebody to implement. Grouping gifts, a calendar example of this would be this. Due to the tax law changes with the Trump tax code, the state and local tax, what they call SALT, is limited to $15,000. Prior to the new change in the tax code, if I was paying a state of Minnesota tax, my property taxes, even those tabs on the car, you could write all of that off, and with the lower deduction, oftentimes you'd have a itemized deduction. Now, many families are no longer itemizing. Why? I have a situation where I'm limited to $10,000 of state and local taxes. Maybe I'm gifting $10,000 a year. The total between these two, because I don't have any medical expenses and such that exceed this, or maybe I don't have the mortgage interest, or it's not enough to put me above $5,100, we have done $10,000 in gifts and gotten no credit as far as the IRS goes. Does this make sense? I can clarify. So because our gifting and the state and local taxes don't exceed the standard deduction, there is no benefit tax-wise to the deduction outside of what you get emotionally. However, what if I wrote a check here between now and December 31st? Let's say I give $10,000 to one charity, it's a church. I could write another check here on December 31st for another $10,000 that would satisfy next year's $10,000 I planned on gifting. By doing this, I add another $10,000 to the $20,000 here. A laser, but if I have 10,000, 20,000, I add another 10 to it because I wrote another check for 2022 on December 31st. Now we have $30,000 of deductions. The standard deduction would stay the same, but the situation here is that now I have $4,900 above my standard deduction. Does this make sense? By doing so at a 30% tax bracket, I would save $1,470. What is that? It's using the IRS's coupon to allow me to do more gifting. A $5,000 gift is still, or a $10,000 gift is still going to charity. The $5,000 months over the standard. Everybody see where I'm going here? I am now letting the IRS actually cover $1,470 of my gifting to charity. The numbers can work substantially higher depending on your situation, so I encourage you to, if this is something you're doing, let's sit down, let's see how we can get more to a charity. Sometimes it's just writing checks yet while we still got time in 2021. Now the idea behind this would be in 2022, maybe I take a standard deduction because I've already gifted for 2022. And by doing so, 2021, you take a full deduction for 2 years. 2022, you take the standard. 2023, you take a double again. And it allows us to better utilize the code, given the chance that, assuming that we have a situation where we're able to. What if I wanted to group more than 1 year at a time? There's a tool that many people, I think, are underutilizing called a donor advised fund. How does this work? Well, we would create a special account for charitable gifting. It's an entity similar to a trust or an LLC called a donor advised fund. Think of the family foundations. Everybody's watched PBS, and this gift was given by the Pillsbury Foundation, something like that. It's all good, Leslie. Anyways, the Family Foundation generally is going to have a lot of restrictions. Once I put the money in, a certain money has to come out. There's a whole new tax return that has to be done with it. And for the average family that's working with secure retirement here, it doesn't just make a whole lot of sense. However, I can go to what's called a public charitable organization, different than the private, and I can go to what's called a donor advised fund. It would allow Paul here to put aside a certain amount of money into this account. I'm no longer limited to 1 year's worth of gifting. Let's say I planned on giving out $10,000 a year and I had a highly appreciated stock, a piece of real estate I was selling, something like that. I could gift this stock or I could write the check into the donor advised fund. By doing so, you get the full tax benefit of that in the year that the money goes in. So in 2021, you created a donor advised fund. I would get the full $50,000 in this example that I would get as a tax benefit. There are some AGI thresholds and such we need to work through. But now once the money's in this fund, it grows tax-free and will ultimately go to the charity tax-free. So I can put that $50,000 now to work. We'll put it in the S&P 500. It's growing and doing its thing. And each year for the next 5 years, I could gift to the charity of my choice. The nice thing about this is sometimes we have situations where families have a event, maybe it's the sale of a small business or this real estate, but they don't know where they would like that charitable gifting to go. I can put this into this account and then decide down the road. In fact, with the donor advised fund, one of the benefits is that I don't even necessarily have to decide next year where the money goes. I can allow that to accumulate for several years before I do it. In fact, at the end of the day, if you wanted to, you could allow this to grow for some time. You got your charitable gifting up front, and then when you are no longer here, the family could help distribute this to your charities as you wanted to, whether it's in a lump sum or over time. There are some administrative expenses. We want to review that with you, and it doesn't make sense for everybody. But if you are under the age of 70 and a half and you can't take advantage of a qualified charitable distribution, which I'm about to talk about, this can sometimes make some sense. The next third area I wanted to talk about is what's called the qualified charitable distribution. So the first that we talked about is if you are giving gifts, sometimes it makes sense to give a appreciated asset and let the charity sell that tax-free. You get the full benefit of the gift, and the charity can sell it tax-free, and then you give a larger gift than had you just sold the event, the stock first. The second one is think about gifting, whether it's a calendar gifting by giving twice this year and then taking a standard next, or we can do it next year, or not. And then the third one is using the donor advice. And finally, this next one is only available for those that are over 70 and a half. If you are 70 and a half, you can start to gift directly from your IRA. I can have a check come from my IRA and go to the church, the Salvation Army, the veterans organization that I want to give to, any 501c3. The important thing to note here is, number one, the check has to be made out to the charity from your IRA. You cannot say, I'm going to put it in Bill's account, Bill then is going to write a check even though it came from the IRA. We don't get a qualified charitable distribution if we do it that way. The check can be made out to the charitable organization, mailed to Bill, then Bill can put it in the offering plate at church, but the check has to be made out directly to the organization. Make sense? Only good for those that are over 70 and a half. Another nuance, can't take my charitable gift out of my IRA and put it into that donor advice fund I talked about. The donor advice fund is one of the exempt assets, but any other 501c3 registered charity can accept these gifts, and it's a great way to do that. In fact, it's preferable once I reach 70 and a half. The biggest reason why, I still get the full deduction for that itemized deduction, that standard deduction we were talking about, and it keeps the distribution off of my IRA or my 1040 altogether. So I'm allowed to take money out of an IRA. I don't even have to deduct it to get the full benefit of it. So anybody over 70 and a half, this is usually the way, unless there's a large capital gain event, that we would recommend that they do that gifting.
So you pay taxes when you pull it out of your IRA?
You do not pay tax. So let's...
They get it all. The charity gets it all.
So I'm going to use some round numbers here, Paul, right? Let's assume a 4% distribution, okay? A required distribution of 4%. And let's say I have a $500,000 in an IRA. 4% of my $500,000 would be $20,000. I can give some or all of that $20,000 directly to a charity. When I send it off, I will not have to recognize whatever I gave to charity on my return. So if I give a check to full $20,000 to a charity, nothing would hit the tax return. I could also give $10,000 of that, keeping $10,000 that I would be taxed on at my tax rate, but moving $10,000 tax-free off the return. Does that make sense? In fact, if you have a distribution, in this example I was just using, a $20,000 that's required, you can actually take up to $100,000 from the IRA. It's really a win-win-win. If we're trying to find ways that we can gift to a charity, using a donor advice fund can eliminate future required distributions. It allows me to transfer money into something very tax-free. I don't have to recognize it on the tax return. There's some reasons why some of these grouping ideas might make some sense for somebody, or even the qualified charitable distribution. There's been some proposals that they're going to raise that SALT limit, remember what I was talking about, to a level that we might go to $70,000. It's the current administration. Which means that now we're going to be able to itemize maybe a little bit more. So the ability to group now to itemize later might make some sense. On the other side of this, you know, maybe we wait and see what happens, then we could still use the deductions possibly next year. But a lot of families we've worked with, quite a few have actually looked at trying to do grouping this year with the idea that tax rates are going to change possibly quite substantially next year. Everything we've pretty much talked about here, whether you're doing charitable gifting or a donor advice fund or the qualified charitable distribution, the deadline of this is going to be December 31st. So we've got about 6 weeks in the real practicality part of this. We probably have about 4 because all the institutions out there are very busy with moving money around with IRA distributions and contributions and everything else. They're all backlogged administratively, so the sooner you do this, the better. And if you'd like to visit on it one-on-one, we can do that. Any other questions? All right, well, this week we talked about donor advised funds, the next lunch and learn we've got scheduled. We are going to hold off on a lunch and learn in December. Why? We've been trying to do these on the third Monday of every month. And I know that if I try to have a room full of families here on December 20th, a couple days before the holidays, it's we're setting ourselves up for failure. So we're going to go ahead and hold off on doing anything this month in December. We'll do our next one here on January 24th, which is the third Monday in January. Our investment strategist, our chartered financial analyst, he's a CFP as well as I am. Nate Zeller here will be conducting that. He's going to be talking a little bit about what he sees in the markets for 2022 and kind of review of where things are at through the end of the year. So put that on your calendar. Hope to see families out here and as normal. You're going to miss out on the tacos. Tacos was only for Toys for Tacos here, but next time we'll bring out, we'll probably go back to Jimmy John's or something. But anyways, put that on your calendar. Monday, January 24th, and talk about the 2022 outlook and 2021 review. We're on Facebook, social media, if you'd like to like us there. In fact, somebody was asking me a couple weeks ago, hey, Joe, I know you do your Monday market huddles. Every Monday you do the webinar. Or I want to go back and replay what you did for the lunch and learn. Easiest way to do that, go like us on YouTube, go to Secured Retirement, and we can even notify you every time we post one of these. It should be posted here before the end of the, I don't know if it goes out today, but by the end of the week, before the holiday, before Thanksgiving here, we'll make sure we get this reposted. If you have any questions out there and we haven't addressed it, send us an email at info@securedretirements. Give the office a call if you want to review things, where you're at, if there's charitable thoughts you have. Should you be grouping? Should be using a donor advised fund? Is there a qualified charitable distribution option? Give us a call. Let's schedule some time, and I'll make sure one of the advisors here at Secured Retirements gets back to you. Okay, with that said, everybody else, everybody that's here, enjoy your tacos, and we'll see everybody else here third Monday in January. Have a great day.